Joining us this morning, Citi's Global Chief Economist, Nathan Sheets. Nathan, great to have you. You do say team recession. You say soft landing to all of this.
Well, we remain on team recession, but increasingly we're sweating. Especially over the last week, we saw a fair amount of data that was more consistent with the soft landing narrative. Now, that said, we're holding on to our recession call, essentially because we believe that the laws of economic gravity that we have seen in previous cycles still apply to the U.S. economy. And specifically, in the past, when wage growth and inflation have been as high as they have been and as they are now, part of the unwinding of that process has been a loosening of the labor market, a higher unemployment rate, and a recession. And we still think that tough slog of bringing down services inflation, and specifically non-shelter services inflation, is still ahead of us. And so we've kind of had the easy part of the disinflation process, but there's still a tough slog ahead.
Right. What do you think this will do if we play this game out to corporate profits? I'm trying to get viewers some sense of how markets may react in the next couple of quarters.
Well, I want to be really careful here in that, U.S. ability of the corporates to respond to diverse macro conditions has really been extraordinary. But my sense is that, again, consistent with these laws of economic gravity, that as the economy slows down, perhaps in the middle of next year would be our expectation, that we'll see some deceleration in corporate earnings. But I would also expect the corporates to bounce back fairly quickly, and perhaps even by the end of the year to be back on an upward trajectory.
So, Nathan, you just said that you're increasingly sweating about a soft landing in the sense that we may not get it. So what's changed? Because a lot of the factors you mentioned, a loosening of the labor market, inflation, have been easy. And if you think that rates are going to be cut next year, why are you worried that this is going to be harder than some have predicted?
Yeah, so, our sense is we have seen core PCE, which is the Fed's preferred measure of inflation, moderate from roughly 5.5% at the beginning of last year down by our reckoning to around 3.5% at present. And that's significant progress. But when you look at the composition of the inflation, a lot of that improvement, that's about improvements in supply chains, reduced goods demand, et cetera, et cetera. But when you look at that core component of non-shelter services, that's over half of the index, it hasn't moved down appreciably yet. And again, I'm looking at the PCE index. And our sense is that's tied to this tight labor market. And yeah, we've seen a little bit of signs that maybe the labor market is starting to loosen a bit. But by any historical metric, this is still a tight labor market. And that's the part of the process that strikes us as being really challenging and still to come.